In this presentation, you will learn how to record bad debts and provision for doubtful debts. And we'll learn how to record them in the general journal, in the income statement, the profit and loss section, and in a provision for bad debts account, that is a balance sheet account. Okay. First, we will look at bad debt. And what is a bad debt? A bad debt is when one of your credit customers don't want to pay or cannot pay, right? You sell to them on credit, and afterwards they don't want to pay or they cannot pay. Okay, there are three reasons why customers doesn't want to pay. One is they have died, they bought goods on credit from you, and then they die subsequent before they pay the debt. And then you also have bankruptcy. Some customers, after they buy the goods from you, they run out of money, they lose a job, whatever. But the thing is, they go bankrupt and they cannot pay. And last, but the most important one is dishonesty. Some of them never intended to pay at all. They just wanted to get their goods. It's some things you have to look out for in business. There are people in the business world who want to get your goods and services and they don't want to pay for it. Okay? There are a lot of pirates. The customer then cannot pay or would not pay, and you remain with an asset in your account or in your balance sheet that is worthless. In a case like that, you have to write off the debt as bad. It's called a bad debt. Okay? So you cannot say you're going to be optimistic and you're going to have faith that they're going to pay. There's a concept called the prudence concept, which says that you have to write off the debt as soon as you learn that it is bad. Okay, so the customer's account in Kimberly's sales ledger shows that a sale took place on 11 January 2018 and the amount due was $1,800. By 15 May 2018, it became clear that this debt would not be paid. Kimberly decided that the account should be written off. Here are the required entries in Kimberly's account, books of accounts, starting with a journal entry. Okay, so the first place you record the bad debt is usually in a journal entry. That's the first book of original entry. In the general journal, also called the journal, we'll make a general journal entry. We debit bad debts, 1,800. That's the 1,800 from here. And we credit the customer's account, accounts receivable, Oasis Limited, 1,800. So account is on page 3 of the sales ledger. And the bad debts account is a new account that you open. Now, every account that you find out is bad will be written off and it goes in the same bad debts account. But the account for the customer would be different. So basically the journal entry is the same every time you write off a bad debt. Okay? And what would the sales ledger would look something like this. You have the customer's account here, page number 3, Oasis Limited. You sold here 1,800 to him on credit. When he can't pay, you have to write it off by crediting it. Notice this 1,800 will knock off against this here, and this account will have 0 in it. Afterwards, you're going to stamp across this close and you will not trade with this customer again. In the general ledger, you have the double entry side of it. In the bad debts account, we have Oasis Limited 1800. Okay, and you would have written off the bad debt there. So it's not anything terrible. We look next at the provision for doubtful debts. Right now, with provision for doubtful debts, we have what you call uncertainty. Right, some of your business customers will pay or they may not pay. You are uncertain about whether they will pay. That means they will pay or they may not pay, or that could turn out to be bad, right? But you're unsure about it, right? You have people like that. They may pay or they might not pay depending on what mood they're in. Okay, they might pay your money or they would not pay your money. So you have to make what is called a provision for doubtful debts because you are doubtful whether they would pay you or not. So those debts are called doubtful debts, and you make a provision for it in case they turn out to be bad, or in case it turns out that they don't pay you at all. Right? So what you have is uncertainty. You are unsure whether they will pay you or not. They may pay you as well as they might not pay you, but you're not certain. It could go either way. 50-50 chance, right? And what you have to do is you provide in case they don't pay you. It's called a provision for doubtful debts. Okay, sometimes it's called a provision for bad debts in case the debt turn out to be bad, right? Sometimes it's also called an allowance for doubtful debts. Okay, so let's read this. Let's see what since businesses can experience bad debts from time to time, it follows that the owners of those businesses continually face some uncertainty about whether all of their accounts receivable will actually pay the amount due. The question then arises as to whether it is right to show the total accounts receivable on a statement of financial position balance sheet without indicating that a portion of the debt due may never be received. To ignore the possibility of doubtful debt would be a breach of the important accounting principle. Okay, what does it mean is you are not being prudent. The prudent concept that we learn about in Form 4, right? And that is what all accounting statements should be. True and fair view of the business financial position, right? But if it's not true and fair if you have debts on it that you would not collect, right? Basically, what that is saying, that you have to make provision for the debt that it might eventually turn out to be bad. So what you do is you make an entry to provide for it. You do this by taking some money out of your profit and setting it aside to cover the debt in case it turns out to be bad. To do that, you would debit your profit and loss account with the amount and you credit the allowance for doubtful accounts. It's a new account that you are making. As we said, we could use the word allowance as well as provision. Okay, so let's see an example here how we do it. At 31st December 2015, the account receivable figure after deducting bad debts was 10,000. It is estimated that 2% of debts will eventually prove to be bad debts, and it is decided to make a provision for these. The accounts will appear as follows. You have a profit and loss account. You've taken it out here. 2% of the 10,000 is 200. So you've taken it out of your profit here by debiting profit, and you're putting it over in your allowance for doubtful account by here. So you have set aside some of your profits here to cover any loss that may occur when customers don't pay. It's called allowance for doubtful debt. Okay. In your income statement, it would look something like this. Under the gross profit, you minus in your expenses, you would have the allowance or provision for doubtful debts of 200, and you minus it from the gross profit, right? So that's how it's done, and it's done that way all the time. So the first time you decide you have customers who may not pay you, you estimate them to be about 2%. It has to be an estimate because you're unsure, you're uncertain, you're not sure that the debt will be bad, right? So you make an estimate about 2%, and we calculate the amount, take it out of your profit and loss account, put it in your allowance for doubtful account, and then you minus it from your profit in the income statement. Okay, so it's always the same. But what happens afterwards is that your customers will change because some are paying, you could continue selling, and people are paying you and you're selling and so on. So you will need to revise the allowance from time to time, see if it is enough. But once you have set aside this amount, it remains in the books at this amount until you change it. Okay, so let's see how you go about changing it. Increasing the allowance. When we say change, you mean it's either going to increase or decrease. Okay, if it stays the same, then it hasn't changed, right? We have an example here. Let us suppose that for the same business, at the end of the following year, 31st December 2016, the allowance for doubtful debts needed to be increased. Why? Because the account receivable figure increased to 12,000. Okay, so 2% of 12,000 now is more than the 200 that is set aside, right? Okay, so what you have to do is you have to put in to make that account 2% of 12,000, and that is 240, right? 2% of 12,000 is 240. So it's more than 200 that you have set aside. That right? Remember over here we set aside 200, right? And we need an allowance of 240, so we have to increase it by 40. So the allowance need is a provision for an extra 40. The double entry will be debit profit and loss account with the increase, that is 40, credit the allowance for doubtful debts with 40. These entries are illustrated in the next here. We're going to take another 40 out of our profit and loss here. We're going to put it in here again. We have the 200 that we had originally put in, and the 40 gives us the 240 that we need here. We will notice that the 240 is how much we have now in the account. So we'll carry that into the next year. This will remain here until we need to change it again. Okay, so the gross profit in our income statement would be reduced by 40 only, not 240. Because the previous year we had already set aside 200 and we only set aside another 40 here. Okay, so that's how you increase the provision. Let's look at how you will decrease it. To reduce the provision, you simply do the opposite of what you did to increase it. The allowance for doubtful debts has a credit balance. Therefore, to reduce it, we would need a debit entry in the allowance account. The credit would be in the profit and loss account. Let's assume that at 31st December 2017, The figure for accounts receivable had fallen to 10,500, but the allowance remained at 2%. Right? So it would be now 2% of 10,500. And we will get 210, but we have 240 in the account. So we have more than we need. Okay? So what we're going to do is reduce it down. Right? At the end of that year, we're going to make an adjustment in the account. So we need to reduce it from 240 to 210. So we need to reduce it by 30. The double entry is the other way around now. We are reducing. We debit the allowance and we put back some of the profits that we had set aside back in the profit and loss account. Okay, so our debit goes here in the allowance for doubtful account. This will reduce the 240 to 210, right? And we put in the amount in the allowance for doubtful accounts in the profit and loss account. We put it back in. This here is profit going back in the profit and loss account. Remember when we took it out, when we were taking it out here, we debited the profit and loss account to take it out, right? So when we put it in back in, we will put it on the credit side. Okay? And at a later lesson, we'll show you how we will add this to the profit and in the income statement. Okay? So that brings us to the end of today's lessons. And I have here two problems. And it's at the end of the slides here. We're putting up these slides in the classroom, and you can go and take a look at it and attempt these. If you're having problems with it, you would put a question in the stream, or you can send me an email and we will address it. Okay. I see we have 6 of you there, and the rest of them choose to. I hope they attend any other class, because I have already did this in the other class, right? If you have any questions on this, you have been unmuted.